Welcome to Pie Uncut, where we break down the biggest stories in technology, finance, and the global economy. Today's story is about Robinhood, the trading app that once symbolized the rise of retail investors and how it is now making a bold financial move to regain investor confidence. Robinhood has just announced a massive $1.5 billion share buyback program. At first glance, this might sound like a technical financial decision, but in reality, it tells us a much deeper story about where the company stands today, where it is heading, and what it means for the future of investing platforms. Let's start with the basics. A share buyback, also known as a stock repurchase, is when a company buys its own shares from the market. This reduces the total number of shares available, and when the number of shares decreases, each remaining share becomes more valuable. Think of it like slicing a pizza into fewer pieces. Each slice becomes bigger. Companies usually do this when they believe their stock is undervalued or when they want to return value to shareholders. And that's exactly what Robinhood is signaling. The company is essentially telling the market that it believes its stock price does not reflect its true potential. Now, here's where it gets interesting. Robinhood's stock has had a roller coaster journey. Over the past year, shares surged nearly 80%, driven by a revival in retail trading activity and strong interest in financial markets. But at the same time, the stock has faced significant pressure in recent months, falling sharply due to a slowdown in cryptocurrency trading and broader market volatility. This creates a very unique situation. On one hand, the company has shown strong long-term momentum. On the other hand, short-term challenges have created uncertainty. And this is exactly when companies often step in with buybacks. Robinhood plans to execute this $1.5 billion buyback over the next 3 years, with flexibility to accelerate depending on market conditions. This flexibility is important. It allows the company to buy more shares when prices are low and slow down when prices rise. In simple terms, Robinhood is positioning itself to act like a smart investor in its own stock. But why is Robinhood doing this now? To understand that, we need to look at its business model. Robinhood makes a significant portion of its revenue from trading activity, especially crypto trading. During the crypto boom, trading volumes surged and so did Robinhood's revenue. But when crypto markets cool down, the impact is immediate. Lower trading activity means lower revenue. And that is exactly what we have seen recently. With crypto prices falling and trading volumes declining, Robinhood's growth has slowed. So the company is now trying to send a strong message to investors. It is saying, yes, short-term challenges exist, but the long-term story is still intact. And this is not just about stock price support. Robinhood is also evolving its business. Originally known as a free stock trading app, the company is expanding into multiple areas. It is moving into banking services, credit cards, financial advice, and even launching a robo-advisor platform. This diversification is critical, because relying only on trading activity, especially crypto trading, makes the business highly volatile. By expanding into new financial services, Robinhood is trying to build a more stable and predictable revenue stream. Now let's talk about investor psychology. When a company announces a buyback, it often boosts confidence, and that's exactly what happened here. Robinhood's stock jumped immediately after the announcement, with gains of around 6 to 7% in early trading. Why does this happen? Because a buyback signals two key things. First, the company has enough cash. Second, management believes the stock is worth buying. Both signals are powerful for investors. But there's another layer to this story. This is not Robinhood's first buyback. The company previously announced a $1 billion buyback in 2024 and an additional $500 million authorization in 2025. So this new $1.5 billion program is part of a larger trend. Robinhood is gradually transitioning from a high-growth startup to a more mature financial company, and buybacks are a classic sign of maturity. You often see them in companies like Apple or Microsoft, which generate strong cash flows and return capital to shareholders. Robinhood is trying to move into that category. But here's the key question. Is this strategy enough? Because buybacks can support stock prices, but they cannot replace real growth. For Robinhood to succeed in the long run, it needs to prove that it can grow even when trading activity slows. That means building new revenue streams. It means attracting long-term investors, not just short-term traders. And it means competing with established financial institutions. This is where things get challenging. Robinhood operates in a highly competitive market. Traditional brokers, fintech startups, and even big banks are all competing for the same customers. And many of them are now offering zero-commission trading, which was once Robinhood's biggest advantage. So the company needs to innovate, and it needs to do it fast. Now, let's zoom out and look at the bigger picture. Robinhood's move reflects a broader trend in the financial industry. We are seeing a shift from pure growth to sustainable growth. In the past decade, many tech companies focused on rapid expansion, often at the cost of profitability. But today, investors are demanding something different. They want profitability, they want stability, and they want returns. Buybacks are one way companies are responding to this shift. They are saying we are not just growing, we are also delivering value. In conclusion, Robinhood's $1.5 billion buyback is more than just a financial decision. It is a statement that the company believes in its future, a statement that it is evolving beyond its startup roots, and a statement that it is ready to compete in a more mature and demanding market environment. But the real test is still ahead. Can Robinhood transform itself into a diversified financial powerhouse? Can it reduce its dependence on volatile trading revenue? And can it sustain long-term growth in an increasingly competitive landscape? These are the questions that investors will be watching closely. Because in the world of finance, confidence can move markets, but execution determines the future. This is Pi Uncut, where we break down the biggest stories in technology, finance, and the global economy.